Hello, everybody. Thanks for joining us today. My name is Dan Gebermedin. I'm a partner here on the Flair Capital team. For those who don't know, Flair Capital is a healthcare dedicated VC firm that invests in early stage companies at the intersection of healthcare and technology. We're delighted to have you here today for our 19th quarterly expert roundtable series. In today's session, we're going to do a deep dive on the tech-enabled services industry within digital health. We'll look at some funding data, some recent events, and have brought together a great collection of entrepreneurs, operators, and investors to share their perspective on how to build scalable, durable, tech-enabled services companies. We worked with Rock Health to examine what investors and entrepreneurs have perceived for a couple of years now, that venture-backed tech-enabled services companies have experienced some challenges in the market. We analyzed the Rock Health data, looked at the categories of companies, funding data, that most closely tracked with services, so treatment of disease and on-demand healthcare, and compared those categories to the more tech-forward categories of clinical and non-clinical workflow. And if you look at the data going back to 2020, funding for tech-enabled services, while initially quite dominant, has actually decreased 9% year over year, while the more tech-forward workflow categories has increased 6 to 7% year over year and now overtaken the services category in terms of funding. On the other hand, the recent news of the successful IPOs of Hinge Health and Omada Health have fared very well in the public market, showing what success can look like for successful tech-enabled services companies. And so we'll try to dive into this dichotomy and strategize what does the path forward look like for tech-enabled services businesses. Flair Capital has had the benefit of investing in tech-enabled services for 10 years across our portfolio of over 50 companies. And in the recent couple of weeks, we've actually published a couple of thought pieces examining the KPIs of successful tech-enabled services businesses. We'll do a plug for our blog post. You can go and check these out on our Medium page. And our discussions today will cover many of these topics with a strong focus on outcomes, both clinical and economic outcomes, both patient and enterprise-facing outcomes. We'll examine the tension between growth and profitability for scaling companies and consider tactics and best practices. We'll look at the use of AI and technology in scaling services companies. And finally, we'll study the funding and exit environments for tech-enabled services companies and share advice for founders actively building in the space. And as mentioned, we're thrilled to assemble a great collection of leaders on the front lines of building tech-enabled services companies. On our first panel, we'll have a founder and operator panel. We'll have Tom Lee, three-time founder of Hippocrates, founder of One Medical, and now founder and CEO of Galileo. We have Brooke Boyarsky-Pratt, who is CEO and co-founder of a Flair Capital portfolio company known well. We have Sam Holliday, CEO and co-founder of Oshi Health, another Flair Capital portfolio company, and Tamara Jurgensen, who is the former Chief Growth Officer and Advisor at Oak Street Health. And on our investor panel, we'll have Vanita Agrawala, from GP from Andreessen Horowitz. We'll have Ben Robbins, a GP at GV, and then we'll have Amir Dan Rubin, who was the CEO of One Medical when they went public, and now the CEO and founding managing partner of Healthier Capital. With that, I will invite my colleague, Margaret Malone, to moderate our first panel. Margaret?
Thanks, Dan. It's great to be here. As you mentioned, we're in the midst of a reset or perhaps a revival for tech-enabled services companies. We're excited to learn from this exceptional group of leaders before we turn back the mic to you, Dan, for an investor outlook. So let's jump right in. As Dan described, Tom, you are a three-time founder in health tech. What does durability of tech-enabled services mean to you in today's environment? How has that changed since the growth at all costs era? And perhaps reflect on your experiences building Hippocrates, One Medical, and Galileo.
Yeah, nice to see you. Nice to see everybody, and happy to be on this panel. Durabilities in this market is a tolerance for pain, I guess, is one way to describe it as a founder entrepreneur. But you got to be able to ride these down markets. We're obviously in a pretty heavy down market. When we first started One Medical, it was frankly nobody really valued services or tech-enabled services at that time. So that was a challenging period for a different reason. I think part of it is just where we've come from. You can see that spike in funding in 2021, and that's just created an enormous hangover for the market. But I think if you're building a durable company, you're always focused on the margin profile, the steady growth. And the reality is that service businesses aren't typically scaled overnight. And so I think the patience needs to be paired with that durability.
That's great. And I think we'll touch on some of the margin profiles metrics shortly. And maybe Tamara, I'll ask you kind of a similar question given your role at Oak Street, which grew during a time when discipline, I think you guys emphasized discipline at a time when kind of that growth was often pursued at any cost. So I'd love to hear from your perspective, what were some of the key metrics, strategies that helped improve Oak Street's economic value?
Yeah, thanks, Margaret. I think Tom hit the nail on the head. Best practices and how you approach things need to hold course during the different times, but maybe in different ways and emphasizing different things. So I think the word that comes to mind for me is intentionality. So very intentional about the metrics, how we measured, what we measured. And as we saw in our survey, Margaret, the metrics that matter haven't really changed over time. There's overall growth, there's revenue, there's the funnel, and there's customer acquisition costs. We were very intentional about how we measured these, the consistency at which we measured them, the granularity at which we measured them. I think maybe more interesting than the what is the how and some of the strategies that we employed. We spent a lot of time, as much time as needed, debating the definitions, the data flows, really understanding organization wide what the definition of a patient is, when we're going to count what, when we're going to bake things into our revenue forecasts. There's a lot of options around that, and you need to be really clear on what it is you're measuring, when you're measuring it, how you're counting it or not counting it. Is it a leading indicator? So resourcing the analytic capability as early as possible was an investment that paid off in spades. Oak Street was founded by ex-consultants, so we might have over-indexed on that a bit, but well worth it, because the other thing that enabled was us to very quickly develop a test and learn capability. We may have had strict CAC by channel metrics, but we piloted relentlessly. And being able to run very structured pilots and then have informed insights to pivot off of was fundamental to having a really strong discipline across growth.
We talked a lot about that in an article. I think even when we polled executives getting different definitions of patient engagement, we heard that loud and clear. I'd love to maybe building upon that, Brooke and Sam, we talk a lot about patient engagement with your models. How do you all measure and drive patient engagement and Known Well at Oshi? Would love to double click on the levers, the challenges, and maybe you can tell a little bit about what Oshi and Known Well do today in your response. So maybe Sam, I'll kick it over to you first.
Great. Thank you. So Sam, Oshi Health is a nationwide virtual GI clinic. We can diagnose and treat someone who's symptomatic and doesn't yet have a diagnosis in GI. We can help them get that diagnosis through our virtual care and navigating into the brick and mortar in the local market as well. And then someone who has a diagnosis but is not getting better, we can provide the wraparound care and the missing parts. So if you think about patient engagement, I think every condition area in healthcare, you have to deeply understand what are the gaps? Where is the current architecture in terms of payment and delivery not solving the needs of the patient? Where are there missed opportunities to drive better outcomes? What is the patient struggling with? What are different paradigms of patients in the journey and where are they struggling? And then make sure that you're building something that is going to solve those pain points. I think one of the things that we did fundamentally different was start by actually running a clinical trial on our care model. We were building off of existing evidence around, for example, dietary interventions for GI and gut-brain psychological. There was already a study that had been done showing that if you integrate those into care, you get better outcomes, lower costs, but we needed to prove that to drive our actual value. And so we started by running that clinical trial, and we can talk about that maybe later in the panel. We did that because that would show that for patients, we can get you better in ways that maybe you wouldn't otherwise get. And for purchasers of healthcare, whether it's a payer or employer, we could actually lower total cost and improve outcomes, because then we knew we'd be able to go get this care funded. And so coming back to engagement, we built ourselves to really work with all the different stakeholders, whether it's the purchasers, employers, payers, the local providers, how do we work to get referrals going back and forth? We're fundamentally doing things that the local providers aren't built or compensated to do. And we fundamentally don't do the things that they are built to do. So we're very complementary. So how do we start getting those referrals? And then we also felt there was a lot of pent up demand, people who weren't accessing the system, but would if it was easier and could really convince them that they'd get something different. And so we have a direct to consumer angle as well. Once the patients come to us, they're coming because they have a problem that they feel like we might be able to help solve. And with GI issues, they're very motivated. They feel it every day. It's getting in the way of their life every week, their ability to go to work, to be in social situations because of the symptoms. And so once they get here, they're very engaged because they're focused on, can this finally be the thing that helps me control these symptoms that are impacting my life? And I think Brooke will probably have a similar story, and I'll turn it over to her. But I think the fundamental thing is, once they come, they're very motivated to solve a problem and see us as a key partner to solve their problem. And that's really what we built our entire care model, and our payment, we can come back to that, is really focused on getting symptom control, which is our North Star metric. So Brooke, I'll turn it over to you.
Thanks, Sam. We were reflecting before this on how both of our patient populations, their disease is so central to their healthcare journeys. I'm Brooke Boyarsky-Pratt. Such a pleasure to be here, co-founder and CEO of Known. We are the healthcare home for patients with overweight and obesity. We deliver that with click and mortar, insurance-covered primary care and obesity medicine. So as it relates to our core challenges around patient engagement, it really is the challenge of the disease state itself. And I think that's something really important as folks are building businesses. So what's a little unique about obesity is when obesity, the disease state, gets worse or comes out of remission, that's actually the exact moment a patient typically doesn't want to engage in care. So if a patient has asthma who gets worse, they say, I better go to the doctor. I need to change my inhaler, right? Patients feel so much shame and embarrassment when their obesity gets worse. So traditionally, they don't want to go back to, say, a primary care doctor who they know will just tell them eat less, exercise more, and will shame them about it. They also don't want to log into an app and pay a monthly fee for something they feel isn't working. So that core engagement problem was actually foundational to how we built the company. As opposed to, for example, starting with a clinical trial, we started purely with the patient experience because we felt the biggest problem with obesity care in the country was that patients were treated episodically and weren't retained. So for us, given engagement mattered so much, we fundamentally think that's the only thing that solves obesity. Everything we built was designed to engage patients who are mostly, for us, coming from clinician referrals and word of mouth. So that's things like hiring an amazing care team, creating warm and welcoming spaces, having the analytics to know proactively when we should reach out to a patient. And I'll also just say it meant doing things the hard way. That's a clinic that we have in Boston, right? Not many are building those anymore. But we felt fundamentally like the W-2ing clinicians, that also having clinics in addition to virtual care for this specific disease state and these specific pain points. It's why our retention and engagement are so extraordinary. But I think just like Sam did at Oshi, understanding those patient barriers and building the solution around those, even if it means doing things maybe a little bit less traditionally in today's fundraising environment, is ultimately what gets you those outcomes.
That's great, Brooke. I think deeply understanding the consumer, those unique challenges, those barriers that they're experiencing in today's traditional healthcare ecosystem. And maybe to Tamara, your point, the obsession around data and tracking that data. Tom, I'm curious from your perspective, given you've seen a couple of different models now, particularly on the primary care side, what are some of the lesson learns you've seen or insights in fostering that patient engagement?
Yeah, it's great to hear these stories from other companies that are thinking about different segments, different situations, but I think there are a lot of common themes. One of them is being intentional. I think if you're intentional about the experience, intentional about how you design it, click and mortar, physical first, digital first, that really lends itself well to a great patient experience, which is downstream from engagement and acquisition, but really critical on the retention side. And so I think if you don't really think about the experience side, I think you're losing on an opportunity for word of mouth and just virality. On the acquisition and engagement side, depending on how you find those patients, I do think that being empathetic about the situation, the use case, and what matters to different parts of segments matters. And I think insights in segmentation is really critical to that. How individuals choose to consume primary care, GI health, weight management, they will all be different psychographically, and there'll be different triggers and catalysts. So I think being very intentional about how you design that and acquire it efficiently for the right reasons. I think most people, especially new to the space, think everybody's the same with one ailment or another. And there are a lot of stories and different psyches that capture momentum. And so I think just being intentional about it and always looking at the metrics from a efficiency perspective also help.
Not to toot Oshi's horn, but I think Oshi has done a really nice job of that. And Sam, maybe I'll flip it over to you for this next question around scaling the clinical model. You all were very intentional in focusing on clinical outcomes at the very start, but that comes with balancing the clinical capacity, which can be highly complex in terms of what you need to look at to best manage that. So I'd love to hear a little bit more about your approach at Oshi in terms of the clinical capacity, any trade-offs or lessons learned as you've scaled that.
Yeah, absolutely. And again, we started with what is the right model, like Tom and Brooke both mentioned, to solve the patient's problem and to fill in the gaps in the way they're trying to get care today. To us, we believed that there's an access challenge where people want support figuring out what's going on. And so we felt we needed to have the ability to take somebody in and help get a diagnosis. Then there's a gap in the types of treatment they can get from the current care delivery. So that it was missing the dietary and the gut brain psychology. And so we thought we need to be able to staff and implement and scale those missing parts. I'd say the final part is we don't believe historically that these were things that would be effectively delivered with coaching or an app only. And so we felt it needed expert, iterative, team-based care, like truly a team sport delivering care wrapped around the patient. And I think Brooke is nodding, I know same philosophies there. That then led us to say, okay, if we believe all those things, we don't think a 1099 contracted transactional workforce of clinicians is going to work. We really felt we need W-2 employed clinicians. Our care model is fundamentally different enough from the way all these clinicians would have worked in a previous setting. And it was so core to getting the outcomes that matter. And those outcomes are core to getting the financial cost savings that matter to help us get it reimbursed. And so we had to build a multidisciplinary. We have 6 different types of licensed clinicians on our team. We also wanted to scale nationally because this is a problem everywhere in our country. And because of state licensure, it's very hard. Time and money are required to get 6 different types of licensed clinicians available in every single state with enough sort of redundancy for people going on leave of absence in your clinical workforce, for example, that you could really scale that access. And what we've learned now is, as we've done all of that, it took us 18 months, we've really unlocked demand. And now as the demand is growing, there's more patients that want to come to us for care. We're learning a lot of great lessons around how do we actually ensure supply at a very sort of micro level, like in that state, based on if we launch a new employer customer with a big presence in Mississippi, which is a pretty restrictive state from a licensure perspective, how do we make sure we have enough capacity for that new employer partner who's going to potentially promote it heavily and has a huge access? Mississippi has massive access issues in GI. So how do we now balance the supply and demand equation? And so analytics are a big part of it. Tamara's smiling. She's talked to our team about the learnings from Oak Street. So maybe I'll turn it over to her on this.
And Tamara, yeah, I would love to hear your perspective, especially sitting in that growth seat. How do you convince the board, CEO to make those trade-offs? I imagine there's trade-offs.
There are trade-offs, and I think having those honest data-backed conversations are critical. I love the example Sam just gave. Brings back lots of memories to that healthy tension in terms and why growth needs to be positioned as a very sort of integral part of the wheel, because by definition, a scaling organization is dynamic, and the proposition and capabilities are iterative, dynamic. So the growth engine is working with a changing proposition at times, and that long tail engagement and retention, the starts with first conversations on the selling growth side. So having that connectedness, having that agility, and knowing when trade-offs are being made where, whether it's for capacity, whether it's for turning on or turning off different services, whether it's contracting opportunities, having that integration and ongoing conversation very honestly, so you can put your best foot forward on the growth front, is so critical. And I think it's the fun, right? It brings everybody together on shared agendas for managing the balance of growth and proposition development and service delivery and great outcomes. So I think it's a really tough but enjoyable conversation to be in.
And maybe Sam, Tamara, you guys can comment on this. Take us back to that board discussion. I imagine maybe Brooke, you have some insights here too. Like, is your board aligned in that vision? Do you have to convince them? Both Oshi and Known Well today have the data points to say this is worth the investment because we know like how it may play out. But maybe just take us to that conversation. Was it mixed feelings across the board in terms of investing and the costs associated with creating that capacity without maybe knowing how it may play out?
I think it has to be tied specifically to your strategy. So for us, we had both health plan and employer customers saying, we can't work with you if you're not nationwide. But if you are nationwide, you're going to get access to this big population of people who we know need our services. We know pretty predictably how many do. And so it was really like, okay, what do we think the cost and investment and time is required for us build nationwide? Now, not every business needs to be nationwide. So I think that's where it ties to the strategy, right? We had the debate of, do we focus more regionally or locally and start there and try to build around a health system partner, for example? So you've seen other businesses use that model. So I think it's just part of your strategy has to incorporate what is the supply needed to execute it.
I'll add, we had this exact board meeting a few months ago. I know Vanita's going to talk later, so she'll remember it. But we had opportunities similarly with employers and pharmaceutical companies that for us moved going nationwide up on the roadmap. And we had a board meeting specifically about this where we were overwhelmed by demand for our national virtual clinic and we went to waitlist in 4 days. And we thought we had hired enough clinical capacity. And as you can imagine, there were a lot of companies out there who will rent you clinicians who came knocking on our door as soon as we went to waitlist because they knew that this would be a revenue opportunity. And it was a quick board meeting, but it was one in which we said, look, this is fundamental to our payer strategy, fundamental to our engagement strategy, that these are high quality W-2 clinicians. And we essentially said, we're going to build this capacity the right way, even if we're pushing revenue out a bit to make sure that we've built something sustaining. And I think the thing that was helpful with our board members was then to be able to very quickly show our clinical outcomes for those virtual only patients look almost identical to those patients who see us in a hybrid capacity. So not just making the case on the front end, but then tracking the data to say, are we continuing to make the right decision, has been helpful to keep everybody aligned.
That's great. Oh, I could keep going on this topic, but I do want to segue, talk about tech. AI is top of mind for everyone, particularly investors, and I'm sure the investor panel will talk more about this. But Brooke, would love to hear from you. How are you thinking about both evaluating and integrating AI today? And where do you see the biggest opportunities maybe in the future here too?
So I think everybody has to, again, you do have to have a nuanced strategy to what matters to your company. So like for us, our AI strategy is built around two primary axes. To Tamara's point, just like Mike and Jeff, I was a former McKinsey consultant as opposed to BCG. So we have to have the 2x2s. So we think the AI has to ideally improve on, but at least deliver on our excellent patient outcomes. and it needs to deliver a positive patient experience. That may not be true for some other healthcare companies, depending on the part of the funnel they're in, but where they're playing. For us, that's really important. There's a reason, for example, we haven't turned on AI voice yet. We just, for where our bar is, it's not quite there yet. And then it's a typical build versus buy decision. So for us, like our clinical decision support, we have nuanced care strategies. It's so core to our model. We acquired Alfie. We're making large investments in our AI there. And then look, where we don't think there's much of a moat to be created, we're looking at tools and AI solutions that improve our efficiency. We're not going to be the specialized solution in AI voice, though I bet we could raise a great round if we said we were, whenever we're fundraising next. But understanding, again, where are there things unique to know, and whatever company someone's building, where are there not, and then looking at the solutions. And what I'll lastly say just on that point, founder to founder for folks watching, is as you start to look at tools in each of these spaces, right? AI voice, other provider workflows. I mean, there's already like 10 really good competitors in every single one of these verticals that you can use on the back end. So I actually think this is a great time to be a buyer of these tools, and recognizing that there are so many companies delivering great solutions in the same space, that I would say be bold in how you approach partnerships and how you can help them in addition to them helping you.
That's great. Sam, I know you all did a pretty robust evaluation on the AI front. Anything you'd add to that?
I think you just have to tie it to your unit economics. What is it actually changing in your metrics? And then the only other short thing I'll say is figure out, like, what do you feel like you need to own and have control over? And which parts can you use a third party for? And what infrastructure? I think the part no one talks about as much is the infrastructure you need if you're going to start building your own agents for certain functions where you feel like it should be in-house and you don't want to trust a third party with that. The infrastructure investment's a lot of where our discussion today is. What do we need to build?
That's great. I know we only have a couple minutes left, so I want to make sure we have time for some lessons learned here. As we all know, there's a lot of audience members that are building their own kind of next generation of tech-enabled services businesses. Maybe Tom, I'll ask you, what's one lesson you wish you had known before starting Hippocrates, One Medical, and Galileo?
Yeah, we're short. I'll try to keep it concise since there's so many, but the one that's most current and top of mind is value-based care is all theoretical, and there's not as much known as you would imagine for such a great buzz phrase. We're just continuing to go down the rabbit hole of value-based care and having to kind of design and invent a lot ourselves, given the maturity of the market there.
Yeah, and maybe Tom, I'll keep that thread open. Any advice you'd give to investors in that respect, maybe touching on value-based care or other lessons?
I think a lot of people just don't really understand the true mechanics underneath the hood on value and how do you really normalize it against a benchmark. And then even within a program as mature as Medicare Advantage, how you segment within that to then determine your actual outcomes both on TME and on risk adjustment. So I think just really basic things like that. And ultimately, you're dealing with humans at the end of the day that need to change their behaviors if you're moving durable impact. And so I think there needs to be a thesis around behavior change that I think people tend to also overestimate an organization's ability to do, including ours. A lot of that is just getting enough experience to do so. And I think the huge opportunity still remains.
And I'll just add, there's nearly zero value-based care in the commercial market. And frankly, the plumbing, staffing, and incentives are not there for that to happen quickly.
That's awesome. I think we're up on time here, so I'm going to have to pass the mic over to Dan. But Sam, Brooke, Tamara, and Tom, thank you so much for today's session. Please, audience, reach out if you have questions or want to learn more about what they're building. I'll wrap up here. It sounds like there's quite a few themes, maybe just to summarize quickly. Have a tolerance for pain, be intentional, build the data infrastructure early on, align on definitions, market segmentation, and KPIs. Engagement is foundational, it's key, but you should evaluate relentlessly, test and track those different strategies. Create your AI framework, focus on unit economics, do the buy, build, vend analysis. And Tom, I think your point is spot on. Value-based care is theoretical. And so really understanding what exists today, how you can build, and then maybe there's opportunities to help change it from theoretical to a reality here. So thank you so much for these speakers today. Dan, I will pass it over to you and invite the investors to the table.
Thank you, Margaret. Really great session. As I invite the investors to the panel, my first question was going to be, what have we learned in the last 5 years? And I think part of it, Tom summed it up quite nicely, that value-based care is theoretical. So Ben, I might start with you. You've been investing in this market space for over a decade now. The first 5 years was different than the last 5 years. You've had some great investments in tech-enabled services and exits, Aspire, CareBridge, and you've invested in impactful companies like Brightline. How do you internalize the lessons learned over the last 5 years? We've had a pandemic boom where there was a high need for on-demand and in-home health, a lot of capitally intensive models, some notable failures, early exits. How do you digest the last 5 years in tech-enabled services?
Yeah, I think there has been a lot of pain, no doubt, in the healthcare services and the value-based care market. We continue to be super active, probably more active than we've ever been, certainly as active. In my mind, there's a bunch of stuff that I think we've learned. Maybe the top lessons that come to mind are that we've become a bit skittish on just rapid growth. I think there was a trend, there maybe even continues to be somewhat of a trend towards companies that are super interested in how much premium risk they have under management and how quickly they can get there. And that generally has become, I think, less exciting and more scary for my team. Essentially, we'll get these companies that come in and they'll have 1 or 2 years after launch, they'll have $1 billion+ of risk under management. And I think it's great to get that kind of like commercial traction, but operationally, it's nerve-wracking, especially because just the nature, the risk is a complicated business. And one of the complexities is just the timing of when you know whether your model works. There's usually some early indicators. You can get a sense, certainly on revenue levers, whether there's risk adjustment or rate sell or stars improvements. You can usually get those indications early. Medical expense reduction, which is where a lot of the interest is right now, that's hard. You can use proxy metrics, but ultimately, until you actually go through reconciliation with the payer, it's very hard to know if you've actually saved medical costs or if you haven't. The other thing that we have certainly gotten quite focused on is that where I think a lot of models have fallen over is that they just haven't been crisp about who exactly they're serving and relatedly what it is that they're doing. But that what's the population is such a critical component of risk. And I actually think that's part of why we're investing so heavily is that I think that's where startups can really shine. Whereas larger ACOs, larger health systems often either have a legacy population or are built in a way that's very hard to specify who exactly is coming in the front door. Startups can do that, right? So we've gone, I think, deeper and deeper into more specialized versions of risk, whether that's defined by populations, right? Serious mental illness, I think, continues to be a super interesting space for us. In primary care, I think that's where a lot of the conversation is around, like, what do you mean by primary care? Right. I think that we have a bit of a reaction these days to companies that come in and they're saying we're serving everybody, right? We're going to do the super high complexity, multiple comorbidities, many hospitalizations, high social complexity. And we're going to do when there's grandma who's relatively well, maybe has a chronic condition, but has never been hospitalized. And all of that falls under one catchment. We tend to get a bit nervous that it's very hard to really nail excellent services that are offered to that group. The other thing that we're doing is alternative versions of risk, right? We'll get into risk in areas that 2 years ago, I didn't even know you could really take risk. I think one of our more exciting efforts has been in DME, right? You can take risk on product lines that aren't necessarily even defined by patients, but they're defined by some bucket of spend in a payer that just historically hasn't been effectively managed. And those trends where we can find operators who are going to build in a disciplined fashion, who are going to take the time to really prove out care models before they scale. It's clear who they're serving. It's clear what actions they're planning to take, in particular to reduce medical expense. We're quite bullish still in value-based care.
Yeah, no, super insightful. A skittishness around high growth companies that are taking premium risk, and they may not have gone through the relentless segmentation of the populations that they're caring for or product lines that they're managing to ensure that there is true value in ROI. It isn't just risk arbitrage. So I think it's really thoughtful. Amir, I might ask you the same question from a different lens. You were the CEO of One Medical that took the company public and then ultimately was acquired by Amazon. And in many ways, public market investors were learning about digital health and tech-enabled services, I would say, for the first time. And so I'm curious, what are your kind of takeaways in the last 5 years of investor excitement and perhaps some increased kind of soberness, so to speak, around tech-enabled services?
Yeah, thanks, Dan. And so great to be with you, Dan, and Ben and Vanita. What a treat to be with all of you and great discussion. So thanks for having me here. I often start with, what's the problem statement that a company's trying to solve? And does it have a solution to that problem? It's not per se about digital health and AI or value-based care, even though it ultimately ends up involving those things, but it's really more about what's the problem one is looking to solve and do they have a solution to it? And I think as we have seen what's happened in the macro environment, like over the last 5 years, to me, this is, we've been in a pretty much stable, low interest environment, and then we had dramatic change. So it's the first time in a few decades, really, that you've gone from a zero Fed funds rate to 5.25 in a year and a half. And obviously for these startups, to Ben's point, that were growing really fast, revenues were far into the future, taking a lot of risks. Now you're discounting that future cash flow at a very different discount rate, right? Just like 18 months later. And so that did a number on valuations, and at some level, sometimes better to be lucky and good. But in terms of our timing of IPO and exit, it wasn't that I knew the macroeconomics, it just happened. And you had other companies that did, quote unquote, well economically in value-based care. We heard from Oak Street on the last panel and some others.
And I forgot to mention, One Medical acquired Iora Health, which was one of our portfolio companies.
Yeah,
so
and we acquired Iora Health from you, Dan,
yeah.
which did a good job. And I think what we've learned these last probably 5, 10, 15, 20 years as health tech has become a thing is it's about great companies solving problems with real economic models that can execute consistently over time. And then you have the idiosyncrasies of macroeconomics and, of course, government regulations. Tom nicely, provocatively said on the last panel, is value-based care even a thing? It's been a thing in Medicare Advantage, but not really in the same way in commercial insurance, right? And there's kind of it in dual eligibles, and to Ben's good points, maybe in some specialty areas, right? And that can play out really well if you have consistency. If regulations change, rules change, that's very hard when you're taking a 10-year mindset to build a company. But I'd say in general, it's looking for problems, finding companies that can address those problems, thinking about real economics, real distribution. And I'd say there's many things that evolved, but one of the super exciting things, even now, the work that we were doing at One Medical and some of my other organizations, you could do them faster, better, cheaper now, just because of the technology, what you can automate, what you had to build in a custom way. When Tom started One Medical, we were buying servers, and then we were on AWS, and now you're using agentic AI kind of tools. And so I think it's ultimately going to be not whether you're a digital health company. Remember when we called companies .coms? Oh, they're a .com. You mean they have a website, right? So I think it's going to be quickly evolving to, hey, this is an innovative company that solves a problem, whether it's senior health or weight loss or workflow solutions, whatever it might be, and does it do it well? And then from an investor hat, we're going to say, hey, is this a team that can take it over the long run? Do they have thoughtful ways to execute and scale? Can they distribute?
Yeah, no, I love that. It's focusing back on the problem statement, the actual value proposition, understanding that the market, investors, operators have been learning, right, about the different moving parts in a value-based care model, the sensitivities around regulatory kind of scrutiny and new laws, so to speak, and what that can actually do. But there's increasing opportunity, right? As we have more technological innovation, we can do more on the services side. Vanita, I might ask you the same question in terms of lessons learned over the last 5 years, but maybe transition to where you are today, what you're looking at, what you're getting excited about. You've made some great investments. I'll flag Knownwell, which is also a Flair Capital portfolio company, but Pomelo, Time Care, Waymark, you've made some great investments in the space. So how are you thinking about tech-enabled services today?
I think it's an incredibly exciting time. I will disagree with Ben because I can. We work together and we're friends. That I actually think it's also a time to lean into growth. And I think growth maybe in the past came with some of the scare factors and maybe lack of discipline. When I'll talk a little bit about what I think is changing. But I also think that actually on a go forward basis, there are going to be extraordinary opportunities for growth. The rule, I think, for tech-enabled startups, in some sense, startups of all flavors, is to live within your means, right? And then figure out where venture capital helps you live large. And to live within your means in healthcare means to study the LTV of the population that you're serving, and then design a care model appropriate to the value capture that you can achieve on a reasonable timescale. And every one of those words you really have to knock on and understand, right? What is a reasonable time scale? What is value capture? What is value capture today? What is value capture 3 years from now? And against that, what care model can I design that allows me to live within my means? And typically in tech-enabled services, I like venture dollars and big venture dollars to go towards growth of a repeatable sale, right? That I understand now drives ROI, is a service that someone's valuing, someone's paying for, and the executor of that service, the company, has designed a care model that is living within its means. And that's really important, right? Because if you start living outside your means, you're treating a low acuity population, but you're having to come to the table with huge infrastructure to do that. Your math's not going to work. You're treating low acuity moms who are pregnant and you're doing the birthing centers. That's hard. There's innumerable examples we lived through over the last 10 years where people thought, here's my population. It sort of relates, Ben, to your point around really understanding the patient population, but designed a care model that was not living within the means of what the economic rails permit for that population. So what's changing now that really excites me is that we're going bimodal. So on the one hand, and personally probably where I get most excited, is tech-enabled services companies that can actually deliver high quality care to high cost claimants. And so Ben mentioned SMI. I love oncology. I love high risk maternity. I love high risk cardiovascular care. Where are there opportunities where we know these are high risk claimants, or we can predict that they will be high risk claimants, high cost claimants, and that gives me the breathing room to live within a slightly larger box and design an even more impactful care model. Obesity care, I think, sits in that category too. And actually use AI tools to drive down the cost of that care, but do it in that bigger balloon where I know these are high cost claimants. Or the other end of this bimodal barbell that I see emerging is a near zero cost of care for low cost claimants and for low acuity care, to the point where we're going to have to ask as an industry, are those services? Or are they instant care triage pathways that look more like infrastructure and triage into other services? So those are the two places that I think we're spending the most time, is a near zero marginal cost triage infrastructure for the healthcare system that we actually see can now finally be built. And there, the critical alpha required is to triage well to other service providers, to specialists, to in-person care, to high-cost procedures, and to get that triage right. And on the other end, if you're going to take on a population and design a tech-enabled services care model to do it, we really like models that focus on high-cost claimants and move the needle for those populations.
Yeah, no, super insightful. What I heard was high growth, but responsible high growth is an area that a theme that you're looking for. I love the concept of focusing on the value that can be created. In some ways, it's like an LTV to CAC calculation, but then also looking at the cost to serve and making sure that cost to serve matches the value potential and the value actually being created. And I love this concept of this bimodal, again, relentless kind of segmentation of the market, and then having a care and business model that matches the population you're serving. And again, talking about,
it's kind of funny,
yeah,
none of
please.
us, we haven't talked about the IPOs at all, but I think probably all of us at some point could have said, or might have questioned whether Hinge had a broad enough surface area, right? Why aren't they doing imaging? Why didn't they set up an orthopedic high quality network even earlier in their journey and so on and so forth? But I actually think it's admirable that they relentlessly kept their care model to within the fan of what they thought value capture was available. And they focused relentlessly on virtual PT, on non-medical care for as long as they could. And so I think these are actually interesting. You can always ask for the moon in terms of a care model and in terms of scope, but some of these examples I think actually represent good examples of constraint on care model.
Yeah, no, that's great. Maybe Amir, I want to bring it back to you. I think we need to flag some KPIs to ensure that you are on the right track, you are making progress. I'm curious, in tech-enabled services, what sorts of KPIs are you focused on? Certainly recalling your One Medical experience, but then with your new investments, right? You've made some really exciting investments in SMI and in May Health and then in behavioral health with Octave. So curious, Amir, how do you think about KPIs as it pertains to tech-enabled services companies?
Yeah, I go back to the problem statements that the companies are looking to solve. And I start with some KPIs around the needs of the stakeholders, a little bit to Vanita's great points of what was the problem you're looking to solve, and are you doing it, and are you doing it well? And in those stakeholders on the demand side could be consumers, which could be metrics around wait time, access, service experience. That is very tough in healthcare, to put it mildly. I like to say I used to be CEO at Stanford's healthcare system and worked at other health systems. And I was at UCLA, the COO before that. It's been over a decade since I've been at UCLA. I probably get an email every other weekend. Can you please help me get into a specialist? And that's with insurance, and that's with access. That's somebody emailing. There's pain around the access and experience, let alone interpreting complex data or now integrating all kinds of data. Vanita and I are both engaged with a company called Function Health. We had a company, Ezra, that was acquired by Function and kind of consumer taking their clinical laboratory data and trying to manage their long-term health and longevity. And Ezra was doing that in kind of consumer-directed AI and imaging. So now I have this, like, how do I interpret this? What do I do with this? Could I have actually gotten an appointment to have this information? So you have these problem statements around the needs of consumers. You have problem statements around the needs of those who are paying for care. I'll use My Health in the serious mental illness as an example. These are patients discharged from the hospital with schizophrenia, psychosis. Goes a little bit to Ben and Vanita's points on these complex populations. 1 in 4 typically gets readmitted within 30 days. MI is close to 0. So you could go to a health plan, even in Medicaid, and say, I can give you in-year savings next month. I avoid a $30,000 admission. I also like this, to Ben's good point, is they don't actually have to take global capitation risk. They're actually just getting an intensive payment, and then that dials down. So we look around the stakeholder needs and the business model metrics. And then you jump to the supply side, huge problems around health systems, health plans, coordination of care, staffing, burnout, labor shortages. We're involved in a company called Hyro, which is contact center automation. What you'd think AI can do. Hi, I'd like to book an appointment with Dr. Smith 3 weeks from Thursday. Can go through speech to text, text to speech, can integrate to your EMR, to your phone system. And then how do you coordinate this data? So start with the problem statement of the stakeholders, but then in all of those, it's very much an execution game. Great, what's the time to go live? What did the clients think about that? How well did you interface with the systems? Did you make sure data wasn't sent externally? How often, what's the percent of calls that don't need a human? What's first time resolution? Actually, old school metrics, if you're running like any business, a call center, that's why I go back to those problem statements. I think in healthcare, distribution, I like to say, is nonlinear. It's hard, right? There's a lot of things on, as Vanita and Ben spoke to, yes, your LTVs. And I liked how you're describing that, Vanita, kind of thinking about what those might be in the future and how you acquire those. What are those different channels? What's your effectiveness in those channels? Is it B2C? Is it B2B? Are you through middle parties? Do you need health plan contracts? Each of those is very idiosyncratic. And I think the best companies don't just have a great product and don't just address the stakeholders, but they actually can execute at those other things. And I think over time, that execution is going to matter. You don't do that rollout well, you're not going to get the word of mouth and get that next rollout. So a lot of, I'll call it traditional ops metrics. It may be a software or tech company, but nevertheless, is it delivering on the solution to the customer? What does the customer think about it? Things like engagement or activation. You sold it to the employer, but then the employee needs to know about it. Then they need to download the app. Then they need to use it. And then it needs to deliver a result and an outcome. So when you go resell the employer, so each of those is a KPI you need to understand and track. The team needs to understand. You need systems around that. Those are starting with the problem statement, looking at the stakeholder needs, seeing if you're addressing the core problem, but then a lot of execution metrics.
That's great. Amir, completely agree. Coming back to basics, right? Around basic capacity utilization and then cost or value above replacement, getting back to basics. Maybe Ben and Vanita, being tech-enabled services in the age of AI, or at least the third wave of AI. A lot of companies want to adopt AI or want to tell an AI story. How do you perceive some of your existing portfolio companies and then new companies that you're taking a look at if they want to position themselves as an AI company, but they're really providing services?
I would say there's two things happening, right? We spend a ton of time on AI as it relates to our existing services companies. That's my warm blankie as it relates to AI and healthcare, just because when you do that, the commoditization is on your side, right? When we have maybe the durable medical equipment company, Synapse Health, big call center operation, right? Because they're managing the intake of orders from physicians with all of the unstructured faxes that come along with that. They're making sure that patients know where their order is. They're making sure that they can call the provider to make corrections. There's a huge call center operation there. AI, I think, is going to be totally game changing in that kind of operation, right? All of a sudden, that 70-page unstructured fax can be automatically digested and you can pre-populate a prior auth form. Or you can even go upstream and start to have ordering systems where you can in real time tell the ordering provider that they have to make some change to the order, like a real game changer. I think about that as the value of the company is independent of the AI, right? The thing is valuable whether or not there's AI. And then there's the scarier world of AI companies. And in my mind, there's some gigantic changes coming across many industries, especially in industries where there's knowledge work. And where is there more knowledge work than in healthcare? And so in my mind, I believe that in the next couple of years, there's probably going to be some $100 billion, potentially $1 trillion companies that emerge that just didn't exist 1 or 2 years ago. And so I think that's very exciting. I also think there's going to be many difficult stories in the path to getting there. And to me, it's that commoditization risk that each time that we take a pitch from a company that's doing the call center automation that Synapse needs, that is going to be a trend. There's going to be huge changes in the way that health systems interact with patients, with providers, and how to build a big, durable company with a moat sufficient to actually grow into large valuations, to be able to go across the industry and have some differentiator other than just being the lowest bidder for an RFP. That's hard. And so that's how we think about the other side, the AI solutions as an investor. I think that's the big headline question that we're constantly looking to answer is why is this not going to be commoditized? And maybe it'll be because there's real first mover advantage in this space. And the company that gets the mind share first is all of a sudden going to keep that mind share because providers are looking for where to get reliable decision support. And if you can just get in front of them quickly with a reliable solution, that's a moat. Maybe there's something about the safety that truly makes you differentiated and gets you installed in enough health systems that it's hard to displace you. But I think that's the challenge facing the AI solutions companies is how do you solve for commoditization?
I'll just say,
go ahead, Vanita.
every tech-enabled.
You get the last word.
I agree with the general two buckets, right? There's companies that are delivering a service that the world knows is valuable, and often there's already a price tag associated with that service, whether or not you're using AI, and AI is primarily an amazing margin driver. And then there are companies that are going to do things with AI that we don't know how to value yet because we're not doing them yet. And that's real too. So I think both categories excite us tremendously. I will say in the former bucket, which are most of the tech-enabled services companies we all look at, I think they should all be AI companies on the inside, and they'd just be remiss, right, not to be exploring, trying, experimenting with the technologies that exist today. And I don't think of it so much as, do you have an AI story or do you not? You all need an AI story, because it's anyone who's a consumer, right, experimented with the LLMs for healthcare or seen some of the back office efficiencies that are obviously attainable now for every tech-enabled services company, knows that there's a real lift to be had there. So my view is genuinely that everybody is an AI company, and then keep our eyes open, right, for the moments of shock and awe where we're like, wow, our healthcare system was just not even doing this today. We don't know how to price it. We don't know how to think about it, but let's get creative.
That's great. Last word, Vanita. Thank you so much. It seems like there's a lot of excitement around significant transformation, but then there's the fear of commoditization. So you have to relentlessly think about your moat. Thank you all so much, Amir, Vanita, Ben. And as they leave the stage, thanks to the audience for joining us today. We hope you learned from the discussion and took away some helpful thoughts and insights that you can apply to your business and your work. Please don't hesitate to reach out to continue the conversation. And be sure to join us for our next quarterly roundtable session on September 23rd at 12 Eastern. Thanks, everybody, and have a great day.